Hey, welcome back. Today we're talking about retirement savings and specifically some practical, straightforward strategies to help you actually build toward it, even if right now the answer to "are you saving enough" is a hard no. And if that is your answer, you're not alone. Saving for retirement is one of the biggest financial challenges people face, and the truth is that retirement preparedness levels are pretty low across the board. Most people know they should be saving more. The gap is between knowing and actually doing it. So, today we're going to close that gap a little. 6 simple, actionable tricks that can make a real difference in how much you're building toward retirement without overcomplicating your financial life. Let's get into it. Tip 1 is the most important one on this list, and it's this: automate everything and pay yourself first. Here's the core idea. If you wait until the end of the month to save whatever is left over, there usually isn't much left over. Life fills the space. Expenses appear. The money disappears before it ever makes it to savings. Paying yourself first flips that around. You move money into savings before you ever have a chance to spend it, and you build your life around what remains. The most common way to do this for retirement is through a workplace retirement plan, a 401k, 403b, or similar account. Contributions come directly out of your paycheck before it hits your bank account. You set your contribution rate once, and after that, it's essentially automatic. You don't have to make the decision again every month. If your employer offers a contribution rate escalator, a tool that gradually increases your savings rate by a small percentage each year, take advantage of it. These incremental increases are usually small enough that you barely notice them, but over time, they meaningfully grow how much you're contributing. If you're saving in an IRA instead of or in addition to a workplace plan, you can set up automatic contributions directly from your bank account after each paycheck. Same principle. Automate it and remove the decision from your monthly routine. One more thing on automation. Before you ramp up retirement contributions beyond any employer match, make sure you have some emergency savings in place first. Even a small safety net matters. And yes, automate that too. Little extras help as well. Some debit cards round up your purchases to the nearest dollar and deposit the difference into a savings account. It's a small thing, but it adds up. And if you make cash purchases, toss the spare change into a jar at home. At the end of the year, deposit it into your IRA. Every bit counts. Tip 2 is about debt, and specifically, not letting it derail your retirement plans. Excessive debt is one of the biggest obstacles between people and financial independence. Some debt, like a mortgage or a student loan, can be a reasonable part of a long-term financial plan. But high-interest credit card debt, personal loans, and car loans can create a cycle that makes saving for the future feel impossible. A few habits that help here. First, create a personal spending plan, a budget, and actually stick to it. Try to keep your basic living expenses below 50% of your total household income. Pay off your credit card balance in full every month so you're never carrying interest. And when you're about to make a large purchase, wait 24 to 48 hours before pulling the trigger. That pause alone can prevent a lot of unnecessary spending. For everyday discretionary purchases, consider using cash with an envelope system. You set aside a fixed amount for a category like dining out or entertainment, and when the envelope is empty, that's it for the month. It creates a natural limit without requiring a lot of willpower. The goal is to keep debt from becoming the thing that constantly pulls money away from your future. Tip 3 is about building on the good habits you already have and eliminating the ones that quietly work against you. Here's a scenario. You've been paying off a car loan for the past few years. You've gotten used to that payment coming out of your budget every month, and then the loan is paid off. What do most people do with that extra money? They spend it. It gets absorbed into lifestyle spending almost immediately. But here's a smarter move. Keep making that payment. Just redirect it to your retirement account instead. You've already proven you can live without that money. You've already built the habit, so pretend the loan isn't gone and keep the automatic transfer going, just to a different destination. You won't feel the difference, but your retirement balance will. The same logic applies when you pay off any debt. Rather than upgrading your lifestyle, redirect those freed up dollars toward your future. And when your car is paid off, consider keeping it for a few extra years before replacing it. Every year you don't have a car payment is a year you can put that money towards something that actually builds wealth. Tip 4 might surprise you. Learn how to cook. I know that sounds like a stretch when we're talking about retirement savings, but hear me out. The amount of money the average person spends on dining out and ordering in is significant. And when you start cooking more of your own meals, even simple ones, that money gets freed up and can go directly into your retirement accounts. You don't need to become a great chef. You just need a handful of easy, healthy meals you can rotate through. The financial benefit is real, so we're talking about potentially thousands of dollars a year for some households. And there's a secondary benefit too. A healthier diet tends to mean lower medical costs down the road, which matters a lot when you're living on a fixed income in retirement. It's one of those small lifestyle shifts that pays off in more ways than one. Tip 5 is quick and straightforward. Set up automatic bill pay. This one is less about saving money directly and more about protecting the money you have. Missing a bill payment can lead to late fees, and over time, those add up. More importantly, consistently missing payments can hurt your credit score, and a lower credit score means higher interest rates when you borrow for a mortgage, a car, or anything else. By automating your bill payments, you eliminate the risk entirely. Every bill gets paid on time, every month, without you having to think about it. It's a small step that protects your finances and keeps your credit in good shape, which saves you money in the long run. Tip 6 is about one of the most common financial traps people fall into: spending raises and bonuses before they even arrive. It happens easily. You find out you're getting a raise, and before the first bigger paycheck hits, you're already thinking about what you're going to do with the extra money. A nicer apartment, a newer car, more dining out. That's lifestyle creep. And it's one of the biggest reasons people with solid incomes still struggle to save. Here's the discipline that changes everything. When you get a raise or a bonus, commit a significant portion of it to retirement savings before you adjust your lifestyle around it. Increase your 401k contribution rate. Put a chunk of that bonus into your IRA. Because here's the thing, you were already living fine on what you were making before. If you never give yourself that raise in your spending, you'll never miss it. But your retirement account will absolutely feel it. It takes a little willpower in the moment, but it becomes easier the more you do it. And the long-term impact on your savings is enormous. Let's bring it all together. Automate your savings and pay yourself first. Remove the decision from your monthly routine. Don't let debt distract you from building your future. Keep it under control with a clear plan. When loans are paid off, redirect those payments to retirement instead of lifestyle spending. Learn to cook more at home and free up money that would otherwise go to restaurants. Set up automatic bill pay to avoid fees and protect your credit. And when raises and bonuses come in, save a meaningful portion before your lifestyle has a chance to catch up. None of these require a dramatic overhaul of your life. They're small, intentional shifts that compound over time. And that's exactly how retirement savings work too. The earlier you start, the more momentum you build. If this video was helpful, please give it a like and subscribe for more straightforward financial content. Leave a comment below and let me know which of these tips you're going to start with. I'd love to hear from you. Thanks for watching. I'll see you in the next one.